You've talked about the word over software, and I'm not sure if that's caught on as much as convergence, but centered around the concerns about the brewing excesses there. Medallia is a name that you've pointed to for years with this concern. What's interesting to me, Bryan, is that this is an area we've actually had significant exposure to historically, but coming into this SaaSpocalypse, as they're calling it, at the beginning of the year, we were actually notably underweight. So going back to the market prescience around the software space, we'd be curious about, what's your nuanced view on software assets today? How do you identify and think about business quality, which I know is your most important underwriting metric or pillar? How do you think about that in the software space? And just let's double click on the views on the software space.
With software, there's a lot of nuance. So let me just kind of break it out in two pieces. There's the traditional software businesses, which are, think of a financial profile of a 40% EBITDA margin type business. Think of low to moderate growth. And then there's the growth or reoccurring revenue software model that's a little different. That's EBITDA negative. A hope is that the company can grow. And as they grow, they hope to achieve different characteristics. I think there's different problems for both. The problem for the more traditional software is the durability of the model is just more questionable, and a lot of the software assets that are traditional were thought to be so safe that the valuations were 20 or 25 times EBITDA is what they were purchased for. Those high purchase prices then were able to justify 40 to 50% of the purchase price for debt financing, which would have been 8 to 10 times in that context. And when you think about the durability of the business not being anywhere close to where it was 2 or 3 years ago, those multiples are way too high, and so your cushion is thinner. So that is the traditional software concern. For companies that have performed well and have grown their cash flows and they've delevered, and we have a view that the leverage will go into a 5 to 7 times ratio, that is something we are very comfortable lending to and will lend to, and we don't worry. We think a software incumbents have an advantage. The question is, will you invest in the future? Will you embed AI capabilities and accept lower margins? If you're willing to do that, we are okay lending to you, because software has always been a business where the hardest part is getting the customer. If you think about software business, it's always been a 90% gross margin business. I think there's going to be very few companies that, if you have a data angle, if you have a core infrastructure, and if you have a regulatory angle, I think those are the areas that we're focusing on. The recurring revenue loans is where the bulk of the challenge has been. And that's where the companies, I always like to think about the total TAM. The TAM is 100. If you had 2019, you're at 20. If you're growing at like 2 or 3% a year, with COVID, technology investment accelerated, and so you went from a TAM of 20 to a TAM of like, 20% of the TAM to 60% of your TAM. After like 2 or 3 years, you really pulled forward demand, and companies are not growing as fast on the software side as they expected. And so that is the area where there's the issues, personally. So that's where you're seeing the issues on the biggest issues and the greatest losses, and those are pretty much concentrated in the private side.
I'm going to ask that as well.
But it kind of frames it's a little more of a nuanced view as we have. So we've selectively added with the core infrastructure, regulatory and data angle on the software, and it's been assets where price is actually relatively reasonable when we look at alternatives, and that's where we focused our assets.
Interesting. So we've talked a little bit about this as a team, perception or reality of the AI risk with these models. I'm curious of your thoughts there. Is it real? Is it perceived? Is it bad underwriting? What do you think?
Today, it's been a bad underwriting that's occurred from prior years, and people always like to blame something on the macro side. So AI, in my opinion, has had zero impact on any companies that's defaulted to date. It will in the future potentially, but nothing today. So if you had a company on the software side that's defaulted recently, it's not because AI is disintermediated. The solutions from AI have not even occurred yet. It's going to take years for them to develop, years for them to get customer acceptance. And I think if you focus on the areas that we're focusing on, I just don't think a lot of companies, a public company as an example, I can't imagine them ripping a core infrastructure system out or having someone internally do it to save a few $1,000,000 or $500,000 and risk their core network. I just don't see that.
Yep. So I think distilling that down, it sounds like on the syndicated side, we see more opportunity. The private side, it's much more risk.
I would say on the syndicated side, we're selective,
Okay.
highly selective. It's been a handful of names. It's not broad-based. It's been high conviction, concentrated ideas where we think we can make where our risk is well contained, and so that, and I think the issue will be, what do companies do invest in their future, and how do they embed AI capabilities? Are they willing to accept lower margins and grow the TAM? That's going to be the biggest challenge. It's not a great analogy, but the way I kind of think about it a little bit is like retail in the 90s. It's easy to laugh about today, but in the 90s, traditional retailers didn't want to disrupt themselves and do online capabilities. And online capabilities were thought to be margin dilutive. It didn't make sense. But if you didn't invest in order to facilitate what the customers wanted, you lost. Anything with AI, inference is a little different. It's a cost business where you write a prompt, and then that costs money. And so you're going to dilute your margins to embed those capabilities in your solutions.